live on YouTube.
How loud are you gonna holler? There we go.
Holler?
That's right.
That'd be a good little segment video. How do you holler?
That's right.
Do a single
Yeah.
video of them hollering. It'd be kind of funny. Okay.
Good Wednesday, everybody. Welcome to Real Estate 101. Every single Wednesday at 1 o'clock, we do the exact same thing. We get on here, we talk about real estate, we talk about the market, hopefully to provide you with some sort of value. What's up, Noah? Thanks for getting on here. Before we get started, I want to ask everybody on here to do three things. Do you know what I'm going to say? Like, comment, and share the stream. I've already done it. If you can't do it for me, do it for my man Shannon. Every Real Estate 101, we also like to give a shout out. And today's shout out is going to go out to none other than the man himself, sitting to the right of me, Shannon Wheeler with PMG Premier Mortgage Group, the best damn loan company, mortgage company out there right now. Isn't that right?
We definitely try to help.
That's right.
Definitely try to help. We're finding out a lot of people these days are examining what all their options are. The market has sort of changed a little bit. So today we'll talk about some of the ways that we can help people experience a decent kind of payment.
That's right.
To go ahead and get into the stream of ownership.
That's exactly right. Well, before we get into that, right now, everybody, we're just going to go right into the topic. Everybody knows right now is an extremely good but not so good time for buyers. Good as in there's more inventory on the market. Not so good time because interest rates. Everybody's complaining. I feel like everybody's bitching about the interest rates. They're just too high. They've gone up 4 points in the last 6 months. And to be honest with you, you're right. Interest rates are high right now. No doubt about it. But.
There's a big but.
There's a big but right there in the middle. There's a way to get your interest rate down, and that's what we're here to talk to you about today. This is a little thing we like to call the 2-1 buy down, okay? So 2-1 buy down. The reason Shannon's here is because he's a master at explaining this 2-1 buy down. If you're somebody right now that's, interested in getting a mortgage for a house or interested in, buying a house in the first place, you're probably looking at your payment and you say, damn, that's really high. I don't know if I'll be able to swing $3,000 a month. Or I don't know if I'll be able to swing however much it is. There's a way to get that $3,000 number down. So, Shannon, would you mind just explaining to us what exactly do you need to do and how can you get that monthly payment down?
Josh, I'd love to, and thanks for the introduction. And yeah, you're exactly right. We're in a situation right now where what I like to say is a lot of the activity that is just because has kind of gone away, meaning people aren't going to move from one neighborhood to another just because, just because I can get a big check and just because rates are super low. But now we're at a point where the buyers and sellers, and I don't know if you've noticed this in your own practice, but it seems like now a higher percentage of the people have a defined need. It's not so much, I would just kind of like to, or I can make some money by making it. It's because, we're pregnant, we want to move to another neighborhood.
We need to. They have
There's
a motive.
Need. Right. There's something that's happening. Okay, so then our job a lot of times becomes, from the real estate standpoint, still you've got to find them the right house. You've got to negotiate the best deal that you can for them. But then the other part of it is to kind of work with the two disciplines and marry real estate and finance in such a way that it helps people be able to get payments that they can be reasonably afford and so on and so forth, because prices haven't really started to come way down. They've started to kind of stop getting worse or getting higher, right? It's kind of one of those fluctuations in the market. So if you're in that space, I think the first thing is to ask yourself, and I don't know how you think your people would answer this question, but the first question, whenever you're talking about financing, is you want to ask yourself, where do I think the market is going to go, right? So, for example, if you're looking to buy now and you need to buy, it's not whether it's a good time to buy or a bad time to buy. It's the time that you need to buy. And so it's more important that you focus on picking the right person to help you more so than deciding whether to or not to, right?
Exactly.
We've determined that you have a need. Now it's working with the best team to help you get that goal accomplished.
Everybody's got a reason. Nobody just bought. It's not just house. It's not just a house either. It could be shoes. It could be a new car. Everybody buys something for a reason.
Yeah.
They don't just buy something just because. So if you have a reason, depending on your reason, like you just said, I mean, you don't just move to one neighborhood, just because. I mean,
Yeah. Now, sometimes if somebody says, hey, property values have just gotten completely ridiculous and you can move over here, put a check in your pocket and have a lower payment than when you started.
There's
it's
your
like,
reason.
I may be thinking, right.
There's your reason.
That
Money.
sort of stuff has gone
Exactly.
away.
Exactly.
So now we're down to the process by figuring out how we can just help everyday people. We're not talking about the high flying investors. We're not talking about all those people. We're talking about just Joe and Jane. They need to move to 123 Lucky Lane because they've got kids that are starting school, that kind of stuff. So for those people, if you believe that the market is going to improve, but that right now interest rates are elevated because they're trying to tamp down inflation and these other things that they've stated they're trying to accomplish. So to give a little perspective, interest rates have gone from 3 to 7 in a flash.
Yep.
Okay?
How long has it been exactly? Do you know, like 6 months?
Something like that.
Something
It kind of
like
started February, March. It kind of really started to creep up. And the interesting thing, Josh, is, people, I think, have adopted this idea that interest rates have gotten up to 7, and they're thinking, okay, well, it's going to be a long way for them to come back down.
Right.
However, you can't also witness rates go from 3 to 7 in a historically fast fashion, but then also take off the table the idea that they could also come down as quickly. Now, I don't necessarily think that's going to be the case. To frame up our discussion about the 2-1 buy down, the first thing I would tell you is that my belief is that interest rates right now are at 6.8 to 7.1, depending on your situation. All situations are unique. NMLS number 829177, just the disclaimers out there. But so I think we're going to bobble around that 7 mark, and then we're going to start to fall back down where I believe we're going to settle down where the market for interest rates on mortgages is going to be about 5% come late spring, early summer. That's what I think. I think that's the new normal. I don't think we get back to 3.
Yeah.
But I don't think we stay at 7 or more. I think that once inflation starts to respond, once things start to come in line a little bit, they start to feel the pain of some of the inactivity in the housing market.
Yep.
Because, Josh, we see the world through our little narrow window of real estate. But everything that we do in the housing industry supports a lot of other businesses.
Sure enough.
So as soon as housing starts to slow down, then I get calls from people who are wanting to buy a house and they're in the flooring business, and they say, well, we've not gotten as much overtime the last few weeks. You see how it starts to have this
roofs, insurance, everything.
All those things start to filter out. So they'll only let that get bad for so long.
Yeah. Well, I mean, I over the past 3 weeks, it's funny you said that. Over the past 3 weeks, I feel like I've had about 3 people that decided not to pull the trigger on something they really liked because of interest rate.
Yeah.
And because of the monthly payment. They couldn't afford it.
And so now what we've got to do is figure out how to help those people be able to afford that for what I think is going to be a short-ish period of time that we're going to have to deal with a higher interest rate environment.
Sure enough. So
in that case, the 2-1 buy down.
There we go. Let's talk about the 2-1.
Pretty handy. Yep.
So tell me first off, whenever I hear 2 and whenever I hear 1, I'm automatically thinking, okay, 2 and 1, that has a meaning. What exactly does a 2 mean? What exactly does the 1 mean?
Yeah, so in this case, a 2-1 buy down. Now I'm gonna make a little clarification here. There's 2 ways to achieve a lower interest rate. One of those is to actually buy the interest rate down. That's a process by which either through lender concessions or seller concessions or money from the borrower, any number of ways you can buy the interest rate down and get a lower interest rate. That looks something like this. So let's say, for example, today, if you came in my office and you were able to lock in at a 6.875 on a fixed 30-year loan, if you or another qualified contributing party gave 1% of the loan amount, then you could buy your interest rate down from 6.875 to 6.375. Now, that is a straight buy down. Okay.
How much does that cost?
If you have a loan amount of $400,000, then that 1% would cost $4,000.
Okay.
Now, the way that you pencil with that, if you're scoring at home or if you're alone, so ESPN joke you may not. Do you remember that one? Yeah. Anyway, Go look it up. Everybody
right.
under 30, go look that up. If you're scoring at home or if you're alone. Anyway, so in that case, they would spend the $4,000, buy the rate down from 6.875 to 6.375. So then the way you
And that's
calculate,
permanent, right?
correct.
Okay.
So the way you calculate that is you'll take the amount of the buy down. Let's say they spent $4,000, and then you take the difference in the monthly payment, and that will tell you how long it will take for you to recoup that investment, Josh. Okay. So
Yeah.
typically, just to make a few mental notes, for the most part, if you buy the interest rate down, it is typically a 3-year proposition, meaning if you sell that house in under 3 years or refinance in under 3 years, you may leave a little money on the table from the buy down. But if you stay in that house 3 years or longer, you start to make money from that decision. Okay.
So how much? And I know that makes sense. So if a $400,000 house, you can go from a 6.8 to a 6.3. How much money does that save you per month?
Yeah.
Roughly,
So yeah.
roughly.
So
No, not
yeah.
exact.
Well,
I'm
pretty
not
close.
I'm
I mean,
not
we-
an MLS.
yeah, yeah. Well, we can get this actually pretty close because I've calculated some of the payments before. So at a 6.8375 on a $400,000 mortgage, that's going to give you a principal and interest payment of $26.27.
Okay,
And
so
so if you bought it down a
$26.27.
little bit, that'd be about $131
Okay.
a month.
So
Right.
$131 a month. The way I look at it is like this: I'm paying $4,000 to save $130 a month. It's a 30-year loan,
Yep.
right? Chances are you're not going to stay in that house for 30 years, right?
Right.
But let's look at it from a bigger picture. Let's just say you do stay in the house for 30 years. You're saving yourself a calculation, a lot of money.
Yeah, 50 grand.
Yeah,
Anyway.
you're saving yourself a lot.
And so basically when we do the calculation, what we determine is that 30.53 months is what it would take to recoup that investment.
Exactly, which
so
is-
if you invest after 30 months or 2.5 years,
2.5 years,
you're
yep.
making money.
2.5 years.
Okay, so that's one differentiator is to buy the interest rate down. Now the other strategy that we're going to talk about is a 2-1 buy down specifically today.
Yes.
And here's really the difference, Josh. If you are buying your interest rate down, you are paying money to get your interest rate on your note lowered. So for the whole 30-year term, that's a lower interest rate. With a buy down, you're prepaying some of your interest. And this is the way it works. The only contributing parties that can participate in a 2-1 buy down are the sellers and or a builder, because builder seller. So first question is, why is that? Well, the reason for that is if you have 123 Lucky Lane and that purchase price is $500,000, you put 20% down and you're going to get a $400,000 mortgage. When you get that $400,000 mortgage, if you get it at today's current interest rate of 6.875, and that's where you start, right?
$2,672.72.
You got a payment of $26.27 a month. You're at 6.875 for $400,000. With a 2-1 buy down, then you're going to take the interest rate of 6.875, but the 2 means that in the first year of that mortgage, you're going to pay an interest rate that is 2 percentage points lower than the current market rate.
So it'd be a 4.875
4.875 for the first year.
for the first year. So 2 points for the first year.
Yep.
Now, I'm a genius. I think I could probably guess this myself, but the 1 means you're paying 1 point down for the second year.
Correct. Year 3 through 30, you're going to be at your normal note rate.
6.85. Gotcha.
So what's the difference? The difference is that you're prepaying that interest. So let's walk through it real quick. And basically what you'll see is if you start at 6.875 for a $400,000 mortgage, that's going to be a payment of $26.27. Year 1, and so this is what we're going to go through right now, is how to calculate the amount of the buy down.
Exactly right,
So we
yep.
can figure out how to help people put deals together.
Exactly.
So the way you calculate the buy down cost is you're going to take the savings from year 1 and the savings from year 2, add those together. That's the amount of the buy down. Okay. So for example, year 1, if you do the 2-1 buy down, you're going to pay a payment of $2,116. This is just principal and interest only. Your taxes and insurance you pay
Right,
just like
on
you
top
normally
of
would. The only way to really compare those savings is principal and interest.
Sure.
So
That's a $500 difference.
$510
Yeah,
right.
that's a $500 difference. That's
So
a
somebody
good chunk.
buying financing $400,000, that's a $510 a month difference in the first year.
That's a $40,000 truck monthly.
That's a car payment.
Yeah.
I mean, so that comes up to
It's a nice car payment.
$61.30, which is about $61.30 a year. Yeah, and then the next year, year two, you'll be paying a 1% lower rate. Your payment is going to be cheaper by $261 a month, or $31.38 annually. And so basically, you're going to save about $6,000 the first year. I say save. You're going to get the seller to contribute
Right.
that, but you're going to save $6,000 the first year, $3,000 next year. So basically, it's about $9,200 on a $400,000 mortgage.
That's what the seller would be paying at closing in seller concessions, right?
Or about 2.25%. Okay, so couple of things to understand. Your note rate is going to be at that 6.875 regular 30-year fixed loan. You're going to have the seller contribute to pre-buy that interest, but that money is yours.
Mm-hmm.
So that money goes not to the bank,
Escrow
doesn't go to
account.
the seller, it goes to an escrow account. So if you could imagine someone taking your first 2 years of interest, or a big portion of your first 2 years of interest, and putting it over here in a bank account, then they're going to withdraw that difference every month for your payments so that your payments stay. Now, what if, Shannon, we get to spring, late spring, early summer,
Rates drop.
have dropped like we discussed, and now it's a 5% market.
And you want to refinance.
And you want to refinance. The only thing better than financing is refinance.
That's right.
Okay, so you want to refinance. Remember, that money is yours, and
Right.
it's in an escrow account. So if you sell that house or if you refinance, what do you think happens to that money?
You can pay, because whenever you refinance, you got to pay closing costs.
You do.
Now, let me ask you this. Like I said before, I'm a genius, but
Yes.
can that money in the escrow account go towards your closing costs when you refinance?
Yes, it can.
So you're pretty much going to refinance your house for free.
The seller's going to pay you.
Seller's gonna pay you to
in the
refinance
summertime.
your house.
Right. And so technically what will happen, Josh,
Wow.
your genius thinking is on target, but technically what happens is that unused portion of the buy down goes to a principal reduction of your payoff. So it reduces what you owe on your loan,
Right.
but then we'll add the closing costs back, as people do when they typically
Wow.
refinance. So in essence, that is what's happening. So that's why the seller has to pay, because I can't pay it for you and no one else can pay it for you, because any other way that it gets done, then it doesn't make your note correct on your 30-year loan.
Yeah.
So, okay, well, that's Shannon, that's great. All I have to do is find a seller to pay all this money. You know, it's like, okay, well, that's where you get into Josh's world. Josh
The
is the
damn
one
genius.
that's going to go out and take this tool and take this way to get you a great payment for the first
Exactly.
couple of years. And what are you going to do with this information?
Well, it's a very good point. Let's just say there's a house that's sitting on the market. I just was looking at one. It was a townhouse, $400,000. It's been on the market for 90 days, right? Okay, they listed at $420,000. They've already dropped their price $20,000. Now, let me ask you this: if you were trying to sell your house, you needed to move. I mean, obviously, your house is on the market for a reason. Are you going to give up moving, solving your problem, for an extra, what is it, $9,000?
No.
Absolutely not. So you'd be stupid not to, move forward with that deal, because you're at the end of the day, you're getting what you want, you're solving your problem, and the buyer gets what they want and solving their problem as well.
Yeah, a payment that's $500 cheaper the first year,
They get to refinance.
$250 cheaper the
for
next year. Yes. Now, you're going to qualify at the fully indexed rate. So you've got to qualify for that, right? Because that's the note rate that you're going to end up at.
Right.
But what are some strategies from a real estate perspective that you would employ with this 2-1 buy down if I came to you and said, hey, Josh, I'm looking to buy, but these rates are up a little bit. I gotta get a payment that's a little bit less.
Perfect.
Don't have to have it forever, but I know the next couple of years are going to be a little bit touch and go. I need a best payment I get. So then what are you going to do with that information to represent me as a buyer when you go to negotiate?
Yeah, absolutely. Well, the first thing I'm going to do is obviously break down all the numbers with you. Sit down. Look, I'll show them this sheet right here. I'm going to show them this sheet and really just make sense of, hey, you know, if we could find you a house that you really liked, maybe it's been on the market for a little bit, maybe the sellers are willing to go ahead and just pay that 2% up front or the 2-1 buy down up front. I mean, it's a no-brainer why nobody wouldn't want
Now, do you think in the price range that most of your people are in and where most people are buying right now, just so everybody out there's got a little perspective, when we start talking about these seller concessions and we start talking about a buy down costing $9,300, I mean, that sounds like a bunch. And it is a lot of money when it's not my money. I mean, anybody's money that's not my money is a lot to me. I'm going to take very good care of it.
Sure
but
enough.
in this particular instance, talk a little bit about how if you're in that $350 to $450 price range, and again, you got somebody that started out at $420, they knocked 20 grand off just to kind of start the conversation going.
Exactly.
So explain to everyone how a 2 or 2.25% overall contribution from a seller is really not too far out of line with what you can expect.
Well, I learned this from Weatherman. He told us this the other day. If you're looking on the market, there's a lot more inventory right now. There's a lot more houses on the market in that price range. Let's just say there's 25 houses on the market right now that you like. Out of those 25, at least 5 sellers would be willing to go ahead and do it right now.
I agree. Okay.
1 for every 5. The way he explained it, 1 for every 5. If you go call 5 listing agents right now and you said, hey, look, in order for us to buy this house, your seller has to, pay for our 2-1 buy down. Out of 5, at least, at minimum, 1 will.
Do you happen to know off the top of your head what the MLS statistics are for, and I don't know if they track this, do they track the percentage of sales price versus what a property started listing at? Is that something they track?
I could look into it. I don't think so. I do know this.
That's an
just based off of me looking at the market every single morning, doing my thing. I would say it's such a short time to tell because recently, I'd say probably 2 months ago, we really started to see price reductions. I don't know.
Do you think 2.25% is probably? I mean, from the time they start out to the time they actually contract, it's probably more than that.
I would say probably close to 5%.
Okay, so now if I'm a seller and you come to me and you've been just hammering sellers all day long on behalf of your buyers, man, it's like I'm getting you the best, I'm getting you the best, I'm getting you the best, and I call you and say, hey Josh, man, I got to move. You sold me this house.
Sure enough.
I've been living in it for a couple of years. It's great. I got to bail. I'm moving to Wichita. Can you come? Okay, so in that case, now you got to switch hats.
Exactly right.
Because now your job is to get
sell
the seller
house, right,
as much as you can for the best price. But okay, so then how does a 2-1 buy down in that conversation happen?
I'm telling them first thing, especially right now. I'm telling them first thing about this 2-1 buy down. Hey, this is what buyers are struggling with right now, and if you want to sell your house and get the most possible, you have to give the buyers what they want right now.
Now, do you see a scenario where let's take that townhome seller, right, and let's say that seller was your client, and they said, well, Josh, we've all talked, we've agreed, I don't know how your internal process goes, but one way or another, you've ended up deciding we're going to go to 420, right? Okay, so the strategy may be somewhere, and a lot of times I know that you guys give what you know to be market-proven strategies, but then there's going to be times where the market-proven strategy versus what the seller or buyer have in mind are different, right? So in this case, you got your seller strategy, which is we're going to start about 420. Then you may end up in a situation where some people say, well, we'll start at 420 and then we'll move to 4, or we'll do something along those lines. The 2-1 buy down from the seller side can become one of those things where you can say, hey, you don't have to give up as much in price if you're willing to participate in a 2-1 buy down.
Exactly.
So instead of you just lopping off, instead of you just lopping off 20 and then going from there, you can start at your 420, hold a little bit more firm on price, because as a buyer, I want that $500 less per month. I'm not really worried if my little extra. So a seller can use the 2-1 buy down smartly, to get a buyer
Exactly.
signed and still make more money.
It's all strategy. At the end of the day, it's all strategic. And this is how we're going to wrap the show up.
Yeah.
It's all strategic. If you're a seller right now and you're looking to sell your house, like I said before, obviously you have to sell for a reason. There's always going to be give and take, especially right now whenever we're switching, kind of moving into a so-called buyer's market, when it really, statistically, it's still a seller's market. But, you know, a lot of people think it's a buyer's market. You have to be able to give and take strategically and get the most money. And the 2-1 buy down is the best way to do that.
Yeah.
So,
thanks for having me on the show.
yeah,
Josh.
hey, absolutely.
Appreciate
Everybody
it.
give it up for Shane. That was a hell of a job
Tell them
explaining
how to
it.
find you, man.
Hey, check us out. My name is Josh Harrell. If you guys don't know me, I work for the Good Time Tommy team. This is Shannon Wheeler. He's the best damn loan originator, lender in the damn business right now. He works for Premier Mortgage Group. And if you're watching this right now, or if you're watching this later, and if there was something that he said or that I said that just didn't really make sense or didn't really sit well with you, please let us know. We would love to explain more about how you can get a lower interest rate right now in these very, very tough times.
Yeah, very good luck. It's a good opportunity, better time for buyers now than
Exactly
in a while.
right.
Yeah.
Exactly right. Let's take advantage of it, guys. Go out there, have a great day. Thank you so much for watching Real Estate 101. We will see you next Wednesday at 1 o'clock.
Have a good week.